Every cycle has its own story. There's always a reason why prices should go higher, and sometimes the expectations are much larger than reality. People get disappointed, but there's always something new coming up. The newest story is global money supply. It is more and more money flooding into the market overall getting more risk on, and then crypto should appreciate with this. Now, how well does that theory hold up? In this video, we are going to compare various traditional finance metrics. We're going to look at the Fed balance sheet relative to the Bitcoin price development. We're going to look at interest rates, at inflation rates, at comparisons among all of this, and then we figure out how much connection is there actually between TradFi numbers and crypto price developments. Now, here's Bitcoin's history with the narratives. It all started out with the idea of a better money, right? The money that's not inflationary, that's very hard, and that is actually used for commerce. So Bitcoin started with the idea of peer-to-peer cash, anonymous peer-to-peer cash. And at the time, it wasn't used as an investment. It was used to buy potentially illicit products online on Silk Road. When then Silk Road got shut down, and when then also Mt. Gox got hacked. So that was the major exchange at the time. Bitcoin lost 80% of its value. We then had the next narrative, Web3. So this is where a lot of altcoins got born, the blockchain being the better internet, everything becoming decentralized, and we don't have to rely anymore on those big tech conglomerates like Facebook and Google, etc. It will all be just on chain. And that also led to an exuberance in the market with a subsequent crash of 80%. The next narrative was better banking or decentralized finance, right? We don't want to have the gatekeeping anymore by the banks. We want to go bankless. We want to just invest our money in DeFi protocols. This also led to the subsequent bear market when the Terra Luna protocol collapsed. So that was a huge multi-billion-dollar DeFi protocol that promised 20% per annum that then in the end imploded, which led to the next bear market. We then got the approval of the Bitcoin ETF, which brought us from 16K to above 100K. Now we start with a correction again. But right now, why the people say it still makes sense to buy Bitcoin is because the Federal Reserve policy might change. In other words, Bitcoin is now just becoming another risk-on asset, a more levered version of the Nasdaq. Is Bitcoin and crypto as a whole going to go up in price if the Federal Reserve is increasing its balance sheet, if interest rates go further down? That's what you try to figure out in this video. Now have a look at this chart. This is probably something you've never seen before on a single chart. This is the US interest rate over time. So that's in green. And what we see in white, that's the inflation rate. There is some kind of a connection here, right? When the interest rate tends to be high, the inflation rate tends to be high as well, and vice versa. The idea is that the Federal Reserve has to be more hawkish or has to increase interest rates when inflation rates are high in order to stabilize monetary value. When the target interest rate is above the inflation rate, that means it costs real money and real purchasing power to borrow money. When the current target rate is below the inflation rate, that means we get money for free if we are borrowing, because the borrowing costs are lower than the devaluation of money. In other words, we should see a booming economy. We should see more and more circulating money whenever currently the interest rate is below the inflation rate. Now let's have a look at how this monetary tightening and expansion actually correlates with the stock market and how that might correlate to crypto prices. So what we can do here is we can look at the delta. So the interest rate minus the inflation rate. When that's positive, we've got monetary tightening, right? It costs real money to borrow. When that is negative, we get money, quote unquote, for free. The monetary base can expand very quickly because when we take out a loan, we have to pay this with less money measured in purchasing power in the future. So in theory, we should see potentially a declining S&P 500 during those years, and we should see a rising S&P 500 during those years. Now, over the very long term, we know that the monetary base is increasing, right? USM2 is going up and up by a rate of roughly 5.8% per annum. That's why everything is going up in price over time. Everything. So gold, property, stocks, everything that has some value consistently will go up by at least 5.8% per annum, again, because the value of the US dollar is shrinking. So that's what we see over here, right? An expanding monetary base. So we can now look at is the delta of the interest rate to the inflation rate relative to the S&P 500 divided by money supply. So when we are in monetary tightening mode, when the green line is above the white horizontal line, or in other words, when it does cost money to borrow, we should in theory see how the S&P 500 goes down relative to money supply, right? We should see a hard time for stocks, but this is not what we observe when we just look at this time frame over here, potentially where it costs money to borrow. The S&P 500 outperformed monetary expansion by 200% roughly. What we then see since 2005, when we tended to have free money, is again that the S&P 500 still tended to outperform. By not as much, only by 40%, but still, there seems to be not really a connection between those two numbers, right? When we are in a cycle of tightening, there isn't necessarily worse performance of stocks versus when we are in a cycle of monetary expansion, when the real interest rates are negative. Here's another measure that's often brought up. It's the Federal Reserve balance sheet. When this is going up, the Federal Reserve is supporting asset prices because it has all of those assets on the balance sheet. When this is going down, the Federal Reserve tends to sell off their assets to the market, potentially depressing prices. Now, since this is again denominated in US dollars, let's normalize this with the monetary base. So this is now the Fed balance sheet divided by US money supply. Currently, 30% of the US money supply is on the Fed balance sheet. This topped out at 42%. This massive jump over here, that's the global financial crisis. This is also where Bitcoin was born. But first of all, let's compare this chart with the S&P 500. So that's at the bottom. Again, this is the S&P 500 relative to money supply. This is not just in US dollars. So we're normalizing both charts. And how much of a connection really do we see here? Not that much. We crashed in the S&P 500 by roughly 30%. That's when the Federal Reserve entered the market and bought a lot of assets, and then prices continued to drop by another 40%. The central bank continued to buy assets, and yes, the S&P 500 recovered, but then when they stopped buying assets, when the Federal Reserve balance sheet went down, we still saw stock prices trending upwards. We then had our COVID crash, again a quick expansion, but that expansion didn't help asset prices directly. We recovered somewhat, and then with subsequent tightening of the Federal Reserve, stock prices still outperformed monetary expansion. So really, it doesn't seem like there's that much connection between those numbers either. And those are the two main levers that the Federal Reserve has, right? It's got the target interest rate and it's got the balance sheet. And both of those seem to be not that much connected to stock prices. I believe there's too much attention on the Federal Reserve policy. I don't believe that the Federal Reserve policy has actually that much impact on asset prices. In academic theory, it should have a lot of impact, right? Because when interest rates go up, then we should have to discount future cash flows more, and that should reduce the value of assets. But in practice, we don't see that connection. We don't see when interest rates are going up that suddenly prices of stocks are going down. Now let's make the link to the crypto market. That's in the end what this whole story is about. Again, the narrative of the bulls right now is that the Federal Reserve will be more lenient, will be more expansionary in their policies, and thus this should support crypto prices. What we've got over here at the top is the S&P 500 relative to the money supply. So this chart starts in 1959. At the time, Bitcoin did not yet exist. And then at the bottom, we've got the Bitcoin price relative to the money supply. Let's first note that Bitcoin was created at the bottom of the global financial crisis. So it never really saw a real crisis in TradFi, right? This was the implosion of the dot-com bubble. This was the global financial crisis. And all that we have seen during Bitcoin's existence was the COVID crash. We haven't seen an oil crisis, we haven't seen any other kind of crisis that really depressed the stock market. Now, what about this second vertical line over here? That's the COVID crash. And I believe that this vertical line started the correlation between Bitcoin and traditional markets. Because before we were pretty much independent, as in the stock market could go down and Bitcoin trended upwards. We then had our massive Bitcoin crash, right? The ICO bubble boom, but stock markets didn't really do much. But with the COVID collapse, where the stock market went down and we got the monetary stimulus, right? The balance sheet of the Fed went up. We also saw somewhat of a correction in crypto. This was a 50% drop. And since then, the two curves tend to somewhat align, right? When stock prices go up, crypto prices tend to go up as well. When they contract, Bitcoin trends down as well. And then again, now we're going up both in Bitcoin, but also in the traditional markets. So there seems to be now a bit more of a connection post-COVID compared to pre-COVID. But actually, once we run the numbers and we look at the correlation coefficients, we don't see that much correlation across different asset classes. I believe that the narratives that are spun around the different asset classes, that there will be a monetary tightening that will then spill over to the stock market, that will then spill over to the crypto market, that also has some impact on precious metals and maybe on the dollar strength. I think that those kinds of stories are overblown. And here is why I think so. At the top, again, we've got the Bitcoin price, and what we've got at the bottom are different correlation coefficients. So the first correlation coefficient is between Bitcoin and the S&P 500. The second correlation coefficient is between Bitcoin and gold. At number 3, we've got the coefficient between Bitcoin and the dollar strength, so the DXY. And at number 4, we've got the correlation coefficient between Bitcoin and a bond price ETF, so that is TLT. We can see that all of those correlation coefficients tend to somewhat move between -1 and +1. There's no real strong correlation anywhere here. What this means is that all of those asset classes don't move in tandem with one another. They move pretty much independent from one another. So if Bitcoin goes up, the stock market might do something completely different. If Bitcoin goes down, the bond market or gold might do something completely different. My impression is that correlation is really something that only happens within an asset class. So within the stock market, we've got a lot of correlation. When Google is going up, then Microsoft is going up as well, and then Nvidia is going up as well. And it all happens on the same day, potentially even on the same minute. We observe the same thing in the crypto market, right? When Bitcoin is going up, then Ethereum tends to go up as well, and a lot of altcoins tend to go up as well. So within crypto, we've got a lot of correlation as well. The same is true for precious metals, right? Gold and silver tend to go up and down at the same time. The same is true for property, right? Most houses tend to move in the same direction at the same time. So within an asset class, we can't really diversify. If we own 100 stocks or if we own 10 stocks, doesn't make that much of a difference. But if you own stocks plus precious metals, plus crypto, plus something else, right? Property, then we do have a diversified portfolio. So my fundamental idea is that those asset classes have different drivers behind them. They all have different reasons why they go up and down. It's not just one set of different factors that impact them all equally. They have different kinds of movers. Thus, the way we value those different asset classes has to be different. When we buy Bitcoin, for example, it might make sense to just look at the average cost basis, right? Is the market currently rather in losses or in profit? You might have seen the realized price chart on this channel. I talk about this several times. If we buy, say, property, we have to look at what's the gross rental yield. When we buy stocks, we have to look at the historical PE ratios. If we buy precious metals, we might want to look at the gold price relative to the money supply. So there are very different kinds of leading factors that tell us whether or not a specific asset class is cheap or expensive. And because those factors are different, the correlation in the price movement is pretty much non-existent. This makes the game, of course, a bit more complex complex, but it also helps us in a way, because that means that one asset class can just independently from all the other asset classes just collapse, and whenever that goes down, we can sell something that just by chance is currently very expensive, and then we buy the thing that crashed, right? If we long-term believe in the asset class, we can still buy it. We can still buy the house when the property market is crashing down, when at the same time, say, gold went up and we sell some of that gold. So the idea of diversification is not necessarily just to reduce risk, to have better risk to reward because the price fluctuations cancel each other out. I think the main benefit of diversification is that we can take advantage of low prices when they occur in a specific asset class. But again, it's only across asset classes. It's not within an asset class. It does not make sense to own 30 different stocks or 30 different altcoins. It's better to just hold a few positions within one asset class and then just balance the different asset classes as the markets move. Now, here is a seemingly valid criticism. Sometimes I get the comment that if you make that much money with crypto, if you can predict prices that well, why are you even selling something? Why don't you just make money with crypto and give away all your content for free? The reason is I see this community simply as an additional leverage point. So I want to share my results actually over the last 3.5 years, something that I don't see other crypto YouTubers do. Now, I own many things, and I'm not going to share every single thing here publicly on YouTube, but I've got property, I've got precious metals, I've got stocks, I've got crypto that I never sell, and I've got my active trading portfolio for crypto. And the last one, that's what I'm sharing here. What you're seeing over here is my active trading portfolio measured in Bitcoin. But this is not 100% representative of my trading portfolio. So what we've got over here is dollar cost averaging. So I pay money into this portfolio regularly, but we've also got the trading activity. So this is just denominated in Bitcoin. I currently have a trading portfolio of roughly 4 BTC. In black, we've got the US dollar development. In light gray, we've got how much money I paid into the portfolio. And in dark gray is just my target of how much I want to pay in the portfolio. So I'm actually a bit ahead. I paid more into the portfolio than I initially planned to do. What we've got over here is the outperformance over buying and holding Bitcoin for every single month. So we've got now 41 months, and some months I'm underperforming, some months I'm outperforming. And this dotted line here, that's the 12-month average. When you average out all of those data points, you get to 2.1%. So on average, every month I'm outperforming buying and holding Bitcoin by 2.1%. That's my average alpha. Now that alpha, that outperformance over buying and holding Bitcoin is generated by being rather risk off. So I tend to be diversified. I don't take any leverage whatsoever. But at the same time, I do bet on falling prices when it's warranted, just like now. If we take away the dollar cost averaging and we just look at the outperformance, then this is the alpha over time. So over those 40 something data points, the portfolio measured in Bitcoin roughly doubled. Of course, measured in US dollars, it went up more than that because Bitcoin went up during the time. So yeah, that's the transparent truth. If you follow other influencers, then ask them to share the same thing. By the way, my traditional finance portfolio also didn't do too bad because I sold pretty much all of my risk on stuff and I transferred a lot of that money into gold. But you know this probably if you're following this channel for a while already. This is a long-term game and there is both luck involved, but there's also skill. And the longer we play this game, the less the luck component becomes important and the skill component does shine through. It's pretty much like with a casino, right? If you play a very long time in a casino, you will definitely lose money because the odds are in favor of the casino. But if you learn about crypto long enough, then your skill edge can become large enough that in the end the odds are in your favor at the expense, of course, of the people that tend to lose. If you're okay with just having the Bitcoin performance, then you can just ride the waves and everything is fine. But if you want to outperform versus just buying and holding, then it is truly a player versus player game. If you make more than the average market participant, then other market participants have to lose. You have to be more skilled than others. And I'm of course trying to make this easy for the community. That's why I'm sharing my own trades. But I also, on top of that, have got various tutorial videos to help with risk management, to help with how to set up the trades, etc. So that's over here on the premium website. There's more than 100 tutorial videos in total. It's about on-chain analytics, it's about betting on falling prices, it's about risk management, etc. More than 100 videos. Feel free to binge watch all of them. Now here's something I can only offer during times like this, when prices tend to decline and most speculative money is already out of the market. During times like this, there isn't too much growth in YouTube, there aren't too many views on crypto channels. That's why during times like this, I am okay to even make one-on-one calls with premium members. Now I can't do this with everyone, I only do this to the people that sign up for the yearly subscription. So that's currently $1,250 per year, but you are getting my entire attention for an entire hour via a Zoom call, and you're also saving some money over the monthly plan. So it's $250 or 2 months that you're saving. Of course, you can also start off just with monthly and then switch to the yearly payment later on. If it's your first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. Helps the channel grow. See you next time on YouTube, or potentially see you in premium. Cheers.